Okay, good morning, everybody. Happy last week of February. I just wanted to kind of recap where we stood as of last week. Last week, we kind of talked about deferred taxes, and deferred taxes is really an advantage that one can take to free up cash flow. That was the explanation there. There are several ways to create a deferred tax, let's say liability in this case. One is by accelerating your method of depreciation. But in summary, deferred taxes are deferred tax liabilities are created from timing differences. Well, I guess an asset could be created as well from timing differences between your tax books and your GAAP books. GAAP is the U.S. generally accepted accounting principle books, and those differences could create anomalies that would result in a deferred tax asset or liability. There are other ways to create a deferred tax asset, for example. We won't dig into it so much in this course because it doesn't really pertain specifically to Amazon, but you can get tax credits from net income losses. They're going to be in the book. We'll talk about that. But even though we modeled, let me pull up the model, even though we had modeled one way of accelerating depreciation to create a deferred tax liability, we had realized, or I pointed out, that this is creating a big liability, 1804, and then that liability is being paid down. Now, when you compare that to what Amazon had done in the past, negative to positive, this looks like it's trending up, trending positive. So it didn't seem to match what I was doing or what we were modeling. And I went to the annual report to dig into what they were doing. And this isn't unusual. So I wasn't surprised to see such a difference. And if you go to deferred tax, they will list, and we talked about this at the end of last class. So if I can't pull this up quickly, I would just ask you to defer to the last class because I don't want to spend too much time digging again. I want to get to new stuff, but here we go. This is all the ways they are coming up with their net deferred tax asset or liability. And it's more that here's the depreciation amortization. This is the acceleration of depreciation. But there's a lot more that goes into it, more than what we can model. And it is often the case that even though it is important to know that companies do defer their taxes, it is often quite difficult to model. So what I'm going to do is we're going to go and utilize the 7 methods to guesstimate what these taxes will be. And if you remember, we're going to talk about when it comes to valuation, the deferred tax line item gets wiped out anyway. Your DCF, if anybody knows, just thinking ahead, your discounted cash flow formula is net income plus deferred taxes. You're adding it back. You're taking it out of the equation. So when you're using the 7 methods, I know to be conservative is to use negative 29, but you know what? That does not look like a reasonable trend to me because it looks like it's trending upwards. It's trending positive. So this almost looks too conservative. And then I said, well, all right, really you'd want to figure out why this is trending positive and continue that growth. But there's no way to figure it out. I mean, it's going to be very difficult. So what I had done was I just took the last year's for now, knowing that this is a line item that's going to be added back. It's not really going to impact our valuation per se. This is what I had taken. Now, again, this is the ambiguity of the 7 methods. If you disagree and said, Paul, I would have taken an average. Go ahead, take an average of the 3. You're talking about, maybe a 1% difference in our valuation. And when it comes to valuation and estimating a stock price, you're getting a big range. So some of these things, this goes back to what I mentioned in the beginning of the class about knowing where to draw the line in terms of digging too deep and being an efficient analyst. So highlight this if you're uncomfortable with the ambiguity of the methodology, and we can come back to it and see if we tweak to a different projection method, will that really impact our valuation? So I'll leave this highlighted. We can go back and tweak it. Let's get to some more new material, okay? Working capital. This is what I want to discuss today. So in terms of the modeling progress, we have income statement, cash flow. Then we realized we had major holes in this model. Those holes will be filled by depreciation and working capital. Once you have depreciation and working capital, we'll have enough to really build our balance sheet. Then we'll finally have the last piece, managing our debts. So we're moving along. Today we'll cover working capital. Next week, balance sheet. Then we'll dig into our debt schedule and we'll have pretty much a complete model. Then we'll value it. So working capital is really a measure of liquidity and operating efficiency. It's a very powerful tool for business operators to understand where their cash is coming from and going in the short term. Because working capital is a measure of your current assets and your current liabilities. Now, we didn't really dig into your balance sheet in complete detail, but we will learn that your assets is what a company owns in the business. An asset is like property, and a liability is what you owe, your obligations, your debts. Now, a current asset is an asset that will be converted into cash in the near term, 30, 60, 90 days. So an example of a current asset is inventory, for example, because inventory is property in a way, but it will be converted into cash because that inventory is going to be sold. That's a current asset. Accounts receivable is a current asset. Accounts receivable is a current asset because it is an asset. It is what a customer owes us that should be converted into cash within 30, 60, or 90 days. Why? Because you expect that customer to pay us within 30, 60, 90 days. You'd hope so. A current liability is an obligation that's due within 30, 60, 90 days. It's a debt that you have to pay soon. It's a short-term debt. So your working capital is a measure of your current assets minus your current liabilities. And with that understanding, it should be more clear now how an operator would look to the working capital to say, all right, well, how much cash is going to come in within 30, 60, 90 days? And what do I owe within 30, 60, 90 days? So it's a measure of my short-term liquidity. Now, for modeling purposes, and a lot of operators use a narrower definition of working capital. Operating working capital. Operating working capital is a narrower definition of working capital. It is quite literally, your current assets, not including cash. Remember, cash is also a current asset, right? And your current liabilities, not including your short-term debt. Well, what do I mean and why? Well, when we talk about current assets, I mentioned a good example, inventory. Cash is also a current asset, but cash is cash, right? If I want to look at how much more cash, how many of my assets are going to be converted into cash in the near term, sometimes I don't want cash in that equation because cash is already there, right? On the liability side, I mentioned short-term debt as an example of a current liability. What are other examples of current liabilities? Well, accounts payable or accrued expenses. These are bills that I have to pay within 30, 60, or 90 days. So let's say forget cash and debt. If I take away cash and debt, I am left with items like accounts receivable, inventory, accounts payable, accrued expenses. These are all items based on my income statement. These are all operating items. Accounts receivable is based on revenue. Inventory is based on cost of goods sold. Accrued expenses are based on my expenses, the bills that I pay. Short-term debt is not. Short-term debt is a balance sheet item. So a good operator might say, I want to look at not just working capital. I want to look at my narrower definition. I want to look at operating working capital. I want to look at just those core line items that are related to the sales that I'm making and the obligations on those sales. Cash and debt is a distraction. I can infuse cash to make it look like I have more cash than what's actually coming in. I can borrow money with debt to make it look like I have more cash than what I just want to know, based on my operations alone, what's the cash to come in? And it's a very powerful statement from an operating perspective. And we use this in modeling to help us determine and project our future working capital for our cash flow statement. And so I measured that 30, 60, and 90 days is a measurement of what would be short term. And so when looking at these line items, we use the measure of days to estimate and project what these line items may or may not be in the future. And so, for example, okay, accounts receivables is related to our revenue. Why? Because accounts receivables is quite literally the revenue that we did not yet get in cash. If we've recorded revenue of $10,000, let's say, and 7,500 of our customers, $7,500 of those sales were paid in cash, that leaves us with $2,500 to be collected, which means $2,500 is an accounts receivable. If we've booked $10,000 in sales and we have an accounts receivable balance of $2,500, that means 2,500 of our customers did not yet pay us. So the measure of days implies what percentage of those customers, based on our sales, owes us. So if we take that accounts receivable balance and divide it by our revenue, 2,500 divided by 10,000, the implication is 25% of our revenue is yet to be collected. 25% of our revenue still needs to be collected. So if you think about the revenue on an income statement as a year-long indication of your profitability, and if you think about that $2,500 as over a year, how much is left owed, then you can think about 25% of your sales is accounts receivable. And so the methodology is we apply that 25% to the number of days in a year. 360 times 25% is 90. So the idea is, this is just a convention. The idea is that of your year-long sales, 90 days are left outstanding. 90 days of revenue is yet to be collected. That is the convention and the formula. It is literally the accounts receivable divided by revenue times the number of days of a year. Now, quick question, a quick comment. We're using 360, not 365. I've seen some people use 365. You know, there are literally 365 days in a year. You might ask, Paul, why did you use 360? Well, because 360 is divisible by 12. So a lot of times accountants will round down. Number one, there are some holidays in those 365 days. And number two, if you ever build a model and you later want to do a monthly breakout, if you start with 365, then you have to do, all right, well, November has 31 days and December has 30 days, and you have to start to make monthly adjustments. If you did 360 clean and you want to do a monthly model, just divide by 12, even. So a lot of times accountants use 360 as a simplification. And so really, you know, this is a question where you might want to ask your associate, should you use 360 or 365 days? I think the general rule is just be consistent throughout your model. Don't go back and forth. If you decide to use 365, use 365 throughout your model. Okay. So again, the general formula to estimate how many days of your operating items are left outstanding, you take that base accounts receivable divided by revenue times 360. So we use those days as the base for our projection. So if our receivables are 90 days, we're going to use 90 days in the future to estimate our future accounts receivable. We're going to project by analyzing days. Let me show you what that means. Let's go to the model, and we've established that our working capital line items, there are 6, are inventory, accounts receivable. These are working capital assets. These are pretty standard. Accounts payable, accrued expenses, and unearned revenue. Unearned revenue you don't see in every company, but it is the revenue that's been recorded that you have not yet actually provided the service for. You haven't earned it yet. It's a liability. It's a liability until you have conducted that service. So given that these are the 5 working capital line items established by the company, and we know this because this was on the cash flow statement, we go to the operating working capital, which is just a template, and we want to make sure we've lined up or created the same 5 line items. So what I'm going to do is I want to avoid confusion, keep the order here. So they have inventory and accounts receivable. So I'm going to put inventory above accounts receivable. So I'm going to just shift space bar to highlight the whole row, shift down to highlight 2 rows. I'm going to put it above accounts receivable to maintain consistency. Control X. I'm going to arrow up to accounts receivable, shift space, Control Shift plus, flips it. Okay. Those are the only 2 line items of assets that they have. So I'm going to delete everything else, shift space bar, down arrow down, to highlight the line items that we do not need for Amazon. Alt-ED, deletes everything. Okay, now I lost my line. I lost my little formatting line. I'm going to put a formatting line here. Control 1. With my border, I'm going to just click a little border at the bottom. There we go. Okay. So we've allocated space for 2 assets, and we had 3 liabilities. We had accounts payable. We had accrued expenses. So I'm going to change accrued salaries, et cetera, to accrued expenses. And we had unearned revenue. Now, for some reason, this line item did not have a days metric. I'm going to want to put one in. So I'm going to go to total current liabilities, shift space bar. I'm going to Control Shift plus, add a space. And I'm going to copy this down. Shift space bar, days payable, Control C. Come down here, shift space bar, enter. I've copied this line down. Now I have an extra highlight row here I don't want. Take that row out. Okay. I'm probably going a little fast, but you have the video. Okay. Now what I want to do is I want to enter all the items. Okay. That are working capital oriented. Now, what I prefer to do, as we did in depreciation, this is a balance sheet line item. These are balance sheet line items. I do not want to hard code the line items here, and then when I go to the balance sheet, have to hard code the same line items again. There's a red flag for potential mistakes and error. I prefer not to hard code the same line items in 2 places. If this is a balance sheet line item, let's put it in the balance sheet and link it back into here. Just rule of thumb to avoid mistakes. Remember, we did that in the depreciation schedule when we realized we needed our property, plant, and equipment for our depreciation. So we said, let's hard code it in, okay, in the balance sheet. first. So let's take these line items, inventory, accounts receivable. We have inventory, accounts receivable, accounts payable, accrued expenses. I want to make sure they're there. Accounts payable, accrued salaries. We're going to change to accrued expenses. Unearned revenue. I don't think they have here. So I'm going to create a line for unearned revenue, and I'm going to hard code here. Okay, so I'm going to go short-term debt. I'm going to go shift space, control shift plus unearned revenue. So to be super clean, I'm going to hard code the line items in my balance sheet, link them into the working capital. Okay, so let's go to the balance sheet. Let's go. Table of contents. Financial data. Oops, I think I went to selected financial data, which I think was the the sub breakouts. This wasn't the actual financial statements, but let me see if here it goes. I was going to say, let's hope it pops up. Balance sheets. Okay, here we go. So, and you might say, Paul, why not just hard code the whole balance sheet and then move forward? And you know what? I think in the book I do it that way, and you might, but listen, I want to stick with working capital now. So if you're eager and want to just lay out the whole balance sheet at this point, just the historicals, feel free. Okay, but let me just put in inventory. So they have inventory above accounts receivable. So let me flip that, inventory above accounts receivable, maybe being a little bit too particular. Not such a big deal. So 17,174, 17,174. Oops, 17,174. Next, 20,497. Accounts receivable, 16,677. 28,16. All right. Let's jump down to the current liabilities. Accounts payable, 38,192. 47183. Drop down, accrued expenses, 23663. 32439. Unearned revenue, 6536. 8190. Okay. You see the formatting? Isn't that funny? The formatting is in here, and then just lost the formatting here. What I'm going to do is I'm going to Control C. Quick trick. I'm going to copy the formatting throughout. So I'm going to highlight everything. Alt E S. Okay, special. F for format, for T for formats. Enter. Boom. Quick tricks you'll learn. Okay. Now, instead of hard coding there and hard coding here, so 2017 we didn't do. The balance sheet, as you noticed, was only 2 years. I'm going to pull in the line items respectively. 2018 inventory. Okay, I'm going to copy this to the right. Since these are now formulas, these will be black. Okay. Accounts receivable. Pull in. Accounts receivable. Copy to the right. Formula, black. Once again, formatting was here. We lost it here. Going to copy the formatting. Accounts payable. Pull it in. Copy to the right. Accrued expenses. Pull it in. Copy to the right. Unearned revenue. Pull it in. Copy to the right. Let me fix the formatting. Okay. Now you can see what we want to do here. We want to calculate the implied days and use those days to base our future projections. How do we calculate the days? We talked about it with receivables, so we're skipping around, but remember, the receivables was the accounts receivable divided by revenue times 360. So you want to take the balance sheet line item and divide it by the related operating item. If you think about it, what we're doing, it basically is projecting our balance sheet off of our operations. It's one of the 7 methods. percent of operations. But we just take that percentage and we multiply by 360 to get this days convention. Now, one side note of convention. I don't necessarily 100% agree with it, but this is the way it's done. It's not just the accounts receivable divided by the operating item. It's the average of the past 2 balance sheet years divided by the operating item. Why the average? Well, because the income statement is a measure over a certain period of time. 10,000 in revenue means we have generated $10,000 in sales for the year. This balance sheet item, though, $20 billion, is not how much has been accumulated that year. This is just at the end of the year, on the day. What was the measure? What was the result? I don't know what happened throughout the year. This is why you probably hear, well, a balance sheet is a measure at a given point in time, while the income statement and the cash flow statement is how much has been accumulated over a period. It's a measure over a period. I could have 20 billion. I could have one here. Well, then that means I've built $20 billion this year. I could have 20 billion. I could have 100 billion here. That means I lost. How do you know? You really don't. So we take the average. The implication on the average is it's a measure of how much has changed. Now here you can say, well, I had 20 this year, but knowing how much that has changed from last year, it makes this year more meaningful. I take an average. So it's going to be not this divided by revenue times 360, but the average of these two. So let's take the average equals average, AVE or AGE, open parentheses, this year, comma, last year, close parentheses, okay? That divided by my 2019 revenue, okay, times 360, okay? 24 days. That's reasonable. That's actually pretty good. You usually want to see 30 days. The fact that number was normal and sound gives me more confidence that this is an appropriate way to go about this. 24 days. Okay. Now I want to go and do this for every historical number. Let's see how much time we have. Wow, time is flying. I'm having fun. Okay. We do the same with inventory. Now, what is inventory based off of? It's your cost of goods sold. As your inventory gets sold, you book the cost of inventory as cost of goods sold. So we're going to look at inventory as a percentage of cost of goods sold. So it's inventory divided by cost of goods sold times 360. Or in this case, average, open parentheses, this year, last year, divided by income statement, cost of goods sold, times 360. 41, that's okay. 30, 60, 90 is pretty standard. Okay. And we can sum up these individual items. Copy to the right. Let's do the entire asset section so that if you guys want to be, if you want to move forward over the week, I want to show you how to make projections with this time. That way, if you want to go ahead and do the liabilities on your own, feel free to do so. Okay. Now, to make projections, we have to reverse engineer the formula. How do you reverse engineer? Let's look at this slide, okay? Remember what we're doing. We're taking the balance sheet divided by the income statement item times 360. That gives us the days. But if we have the days, we want to solve for the balance sheet line item. We got to solve for X, right? This is 8th grade math. You want to reverse engineer. You don't have the receivable now. You have this number. You want to back calculate to get the implied balance sheet line item. How do you do that? Well, the formula is quite simple. It is the days divided by 360. We're now reversing it. The days divided by 360 gives us the percentage. You multiply by the income statement item. That gives you the balance sheet. So if you want to do the algebra on paper, I'm not going to do it, but you're just back calculating. So now the formula is simply days divided by 360 times the income statement line item. So first, what I'm going to do is I'm going to change the days to be equal to the year before, because that's the point of calculating the historical days. So we have a measure going forward, and the formula is equal to 41 divided by 360 times income statement. Now you might ask, well, what about the average? Well, the implication here is this is an estimate. And you would think that the estimate already includes the implication of averages. So we're not going to go back and unwind the average portion of the formula. That's baked into our assumption. And really what you're doing here is you're literally just basing inventory on your revenue growth. That's really what you're doing. So if our revenue is growing at 30%, your inventory should be rising at 30%. That's really what you're doing, but we're establishing the convention. We can do the same with days receivable, equal to the year before. And we're going to go equals days receivable divided by 360 times income statement cost of goods sold. Copy to the right. Okay. What'd I do? I did something wrong. You guys probably caught it. Did you guys catch it? What did I do here? I'm sorry, guys. I'm embarrassed. I calculated this off of revenue. This is inventory. I'm sorry, guys. I probably threw everyone off. This is 41. This is, in my mind, this was receivables. This is inventory. So let's redo it. This should be based on cost of goods sold. This should be based on revenue. Okay, I'm gonna redo the formula again. Okay, I'm gonna undo. I'll just overwrite the formula. This is equal to 41 divided by 360 times cost of goods sold. This is inventory. That looks a little better. This is 24 divided by 360 times, that's your revenue. There you go. That's a bit smoother. Okay. In my mind, I thought this top one is receivables. Usually the first line item is receivables. I don't know why Amazon had it flipped. So I'm sorry. I hope I didn't throw you guys off. Next, let's see how far we can get. But what I'm going to do in case you run out of time is I'm going to tell you what these line items are based off of so that if we get cut off, you can kind of run with the assumptions. Okay. So accounts payable. So accounts payable and accrued expenses are your expense line items that you owe. Now, quick accounting side note, accounts payable is most often the cost of goods sold bill. Accounts payable is most often based off your cost of goods sold. A lot of people might think that accounts payable and accrued expenses is almost the same thing. It's bills that you have to pay, but technically accounts payable is a bill that's collateralized against an asset, the asset being inventory. So you will often think about, well, inventory cost of goods sold. So accounts payable is typically based off of cost of goods sold. So it's accounts payable is the average accounts payable divided by cost of goods sold times 360. Accrued expenses. Now, when you get to things like accrued expenses, okay, you want to know, well, look, these guys have 1, 2, 3, 4, 5 expense line items. Which expense are they prepaying? I don't know. Is it fulfillment? Is it technology content? Is it marketing? Is it a little bit of both? Well, oops, we have a clue. Okay, and the clue is, if I go accrued expenses, here it is, accrued expenses. They say included in accrued expenses and other is our liabilities related to leases, retirement obligations, payroll, unredeemed gift cards, customer liabilities, current debt, acquired media content, other operating expenses, basically everything. Basically everything. Right. So simply put, and this is often, you'll often kind of find this conclusion. It's a lot of these line items. So we're going to base it off of the total operating expenses. Very simple. So you're going to go, here we go. You're going to do average accrued expenses divided by total operating expenses times 360. Unearned revenue naturally is based on your revenue. Okay, so I'm going to keep going until we get cut off. Usually I get a notice that we're limited with time, but they haven't. Let me see this notice. So let's keep going. All right. So accounts payable is going to be equals to the average this year, last year, divided by cost of goods sold, income statement cost of goods sold, times 360. 98. Okay, a little high. 30, 60, 90. Okay. That's the way they do it. That's the way they do it. This note, I don't know, was probably from an old model. We can delete that. Accrued expenses, average this year divided by last year. I'm sorry, this year and last year divided by, we just established, total operating expenses times 360. 128. It's high. I noted it was high. Okay. Average for unearned revenue this year and last year divided by revenue. Total revenue times 360. 9. Pretty low. It makes sense. You wouldn't think they have a lot of unearned revenue. They got a little bit. Okay. Here are our assumptions. Okay, and I want to total everything. Okay, copy this total to the right, so I'll leave you to make those projections. And just so you know, the total operating working capital, as definition, is the current assets minus current liabilities. I don't like minus signs. I like parentheses. Control 1. Go to your number alignment. Select parentheses, meaning a negative number is in parentheses. Okay. Now, what I'd like you to do is fill out, make your own projections, and we'll compare them next class. Next class, we're going to talk about tying working capital into the cash flow statement. Wouldn't take long. We're done. We're going to move on to the balance sheet next week. Okay, so we're going to tie this into the cash flow statement, talk about the balance sheet, projecting the balance sheet, how to balance the balance sheet, super important. We're going to go into the debt schedule. We'll have a completed model. For all those guys that are new, in the beginning of the month, Amazon had released their new annual report. So I'm going to go through these classes again throughout the summer and rebuild the model based on their new year. I'm going to rebuild from scratch. So if anybody's kind of jumped in the middle of it, I think it's good. It's a good refresher, and their numbers changed. Number one, the numbers changed. Number two, you're going to see how accurate our 2020 projections were with what they actually produced, which should give you guys some good confidence. Even though we're quite crude with making the projections, we were pretty accurate. All right, guys, I'm going to upload this to YouTube and see you guys next week. Thank you for your time.